The ECB hasn't surprised the markets and kept its rate at 1.5%. With slow growth in the Eurozone as well as the debt crisis spreading to Spain and Italy, Trichet said that inflation would be monitored very closely, as well as stating bond buying was never dormant and is an ongoing programme, and said to be buying government bonds of Ireland and Portugal. I'm joined here today by Brian Bagdasarian, Chief Investment Officer at SuisseCap Wealth Management. Welcome to Dukascopy TV, Brian. Now, Brian, ECB President Jean-Claude Trichet said that inflation, now 2.5%, was likely to remain clearly above the ECB's 2% target over the coming months and will be monitoring very closely. We've both watched the press conference in Frankfurt. How would you evaluate Mr. Trichet's speech, and when do you expect the next rate hike?
I think that Trichet at this point is more or less unsure of what he needs to do at all. It's very similar to what you saw happening in the U.S. a few years back. The next rate hike, I believe, will be in September. I think it will continue in that manner. The very fact that the statement was made that they are closely monitoring creates a situation that is all but out of mittens, that they really are just waiting for the other shoe to drop. This is very typical of these kind of double dip scenarios that the U.S. has had happen, and now we're seeing here in the EU.
The ECB, which ceased buying the bonds of distressed euro area governments 18 weeks ago, has been forced to re-enter markets as Italian and Spanish yields keep rising. Do you think more needs to be done to deliver price stability?
The fact of the matter is that we have a situation where in the EU you have 20-odd fiscal policies and an attempt at applying a single monetary policy. Yet there is a surprise every time that a weaker, largely more socialized government tends to have instability and therefore increasing yields. I think, in fact, that if the smart move is made, it would be to step back, allow the yields to increase, and more or less allow the markets themselves to find their own stability. Trying to monitor this like a overly eager parent does nothing other than prolong the inevitable, which is the fact that Italy, Spain, Greece, Portugal, any of these situations are going to implode. Allow that to happen and then deal with the aftermath, as opposed to just trying to keep on sticking Band-Aids on it. Because it's just going to keep on creating this perpetual situation of inherent bailouts, so on and so forth. And it doesn't solve anything. The markets in every situation desire to be efficient. By stepping in, it's not being allowed to occur, which means that we're just prolonging the inevitable, which is a dramatic change in the current EMU and EU setup.
How will we expect the markets to react to this? And of course, what does this mean for investors?
Well, I think that right now, anybody that is holding heavily in the euro needs to be aware that there is an active move towards parity with the other major currencies that hasn't occurred. This is why I think, as of yesterday, the euro versus Swiss franc was right around 110 versus the dollar. It's even weakened significantly, and the dollar right now is tremendously weak. I think at this point, an investor coming into the market should take advantage of the inherent weakness of the euro compared to other key currencies, i.e. the Swiss franc, and really capitalize on it. That is why we're all in the industry and act as investors, is to make money on the movements of the markets. So today, from our point of view, we are looking at regularly shorting the euro. We're seeing that movement back towards parity, and therefore allowing us to kind of diversify out beyond what we normally have been able to do historically, which is have to hold a significant amount in euro because of its inherent strength.
Thank you, Brian. Now, you can catch all the latest news and developments in the financial markets, so make sure you stay tuned. Goodbye.